Most investors are playing the wrong game. They spend years trying to pick the right stocks, time the market, and beat the S&P. And some of them get pretty good at it. But here's the problem. Even if your picks are right, you're still leaving the most powerful wealth-building tool completely unused. And it only activates when everyone else is panicking. Warren Buffett doesn't outperform by predicting the market. Ray Dalio doesn't run one of the most successful hedge funds in history by avoiding crashes. What they actually do is much simpler, and most people are psychologically incapable of doing it. In this video, I'm going to show you a system built around that exact idea. And I'll walk you through a real hypothetical, using real numbers, that shows how this approach could have turned $100,000 into over $200,000 without predicting a single bottom. I've been refining this strategy for years. I've actually used it through multiple market crashes, and it's made me hundreds of thousands of dollars in real returns. By the end of this video, you're going to know exactly how the system works, why Yale professors say it's what most investors should actually be doing, and the one psychological trap that causes people to blow it, even when they know the strategy. Here's the simplest version of what I'm about to show you. You keep your money in a safe index fund. When the market crashes, you move some of it into a more aggressive one. When it recovers, you move it back. That's it. The rest of this video is just showing you exactly why that works and how to do it. Now, before I show you the system, I want to address something most finance channels completely skip over. Why not just pick stocks? Warren Buffett himself has said that the average investor cannot time the market, and the data backs that up. Study after study shows that the overwhelming majority of active fund managers, people with teams of analysts, proprietary data, and decades of experience, fail to beat a simple S&P 500 index fund over a 10-year period. Now, before you click off thinking this is just another hold the S&P and wait video, it's not. I'm going to show you how to turn market crashes into the most aggressive wealth-building moments of your investing life. If professionals can't do it consistently, the odds for the individual investor are even worse. But here's the thing nobody actually talks about. It's not just about picking the right stock. It's about sizing. Think about it this way. Even if you had incredible conviction in one company, let's say you genuinely believed it was going to double, could you put your entire portfolio into it? Probably not, because the downside of being wrong on a single stock is catastrophic. So you size it at 5%, maybe 10%. And even if you're right, a 10% position that doubles only moves your overall portfolio by 10%. That's the invisible ceiling on stock picking that nobody talks about. But with the S&P 500 or the NASDAQ, you can go all in. Because you're not betting on one CEO, one earnings call, one product cycle. You're betting on the entire engine of human innovation. The diversification is built in. The sizing problem disappears. And if you're already holding the index, which is already the smarter move for most people, research from Yale says you're leaving serious wealth on the table by not adding a layer of measured leverage while you're young enough to recover from volatility. That's exactly where this system comes in. But first, you need to understand a trap that's quietly killing the returns of almost every investor who thinks they're being smart. Most people think the smart move is to hold cash on the sidelines. Wait for the dip, then deploy. Sounds completely logical, but there's a math problem hiding inside that plan. While you're sitting in cash waiting for a crash that might not come for 1, 2, or even 3 years, the market is compounding without you. The S&P 500 has averaged around 10% a year historically. Cash earns maybe 4 or 5% right now. That gap is called cash drag, and it's silently killing your long-term returns. So you wait. The market doesn't crash. You keep waiting. Now you're 2 years behind. And when the crash finally does come, you've already missed so much upside that even a perfect entry at the bottom doesn't fully make up for it. But here's where things get really interesting. What if you never had to hold cash at all? What if your entire portfolio was always working, always compounding, and you still had a weapon ready to deploy the moment things fell apart? That's exactly the problem this system solves. And it comes down to one simple shift in how you think about your core position. But before I show you how it works, you need to understand something about leverage that most people get completely wrong. When most investors hear the word leverage, they think casino. They think blown-up accounts and margin calls. And honestly, They're not wrong about misused leverage. But here's the twist. Warren Buffett uses leverage. Berkshire Hathaway has historically operated with roughly 1.6 to 1 leverage through its insurance float. Ray Dalio built his entire all-weather portfolio around the intelligent use of leverage, not to chase returns, but to balance risk across the whole portfolio. Even two Yale professors, Ian Ayres and Barry Nailbuff, wrote the book on this. Literally, it's called Life Cycle Investing. And their core argument is that young investors should actually use 2-to-1 leverage early in their investing lives to spread their market exposure across time. Think about it this way. Most people have very little money when they're young and a lot when they're old. That means almost all of your wealth building happens in the final decade before retirement. Life cycle investing says that's a structurally broken approach. Using measured leverage when you're younger smooths your exposure across your entire investment life. And what they describe as the right way to execute this is almost exactly what I'm about to show you. But here's what most people miss. Leverage isn't about being aggressive all the time. It's about knowing when to use it. And that's what this system is built around. Here's the foundation. Instead of holding cash on the sidelines, you stay fully invested in a broad growth index. The one I personally use and recommend is called VOOG. Think of it as the S&P 500, but with the lowest earning, weakest growth companies stripped out. You're left with the 500's best performers compounding without the dead weight. I love this ETF. It's been the foundation of my own portfolio for years, and it's where I'd tell any investor to start. Now, when the market drops, and it will drop, you don't scramble looking for cash that isn't there, because your VOOG position is your dry powder. You rotate a portion of that position, maybe 25 to 30% of your portfolio, into a 2x leveraged NASDAQ 100 ETF. The one I use is called QLD. Think of it this way. VOOG is your calm base. QLD is your tactical weapon. And you only deploy it when the market gives you a real reason to. But here's the part most people get wrong. They think of leverage as all or nothing. You're either in or you're out. That is not how this works. You scale in. When the market's down 10%, you put in a small position. Down 20%, you add more. Down 30%, you go harder. You're not guessing the bottom. You're building a position across the fear. Every tranche you add is at a lower price. Your average cost keeps improving the whole way down. Michael Gade, a well-known portfolio manager and CFA, has built an entire career around a version of this. He uses market indicators to flip between risk-on and risk-off modes. When conditions signal opportunity, he adds leveraged exposure. When the signal shifts, he rotates back to the core. That's the professional version of exactly what we're talking about. Now, let me show you what this looks like with real numbers, because this is where it gets hard to argue with. I want to walk you through a hypothetical using one of the most documented crashes in recent memory, COVID, February 2020. Here's the setup. You've got $100,000. All of it is in VOOG. You're fully invested, zero cash drag, compounding the whole time. Then the crash hits. That's when the system activates. You start rotating your VOOG position into QLD in tranches. When QLD drops around 20%, you deploy 10%. As it falls further, you add another 15%. At the bottom, 25% of your portfolio at maximum fear. The NASDAQ recovery from the COVID crash was one of the fastest in market history. Driven by the shift to remote work, cloud computing, and tech spending, the index didn't just recover, it surged. By late 2020, QLD had more than doubled from its March lows. By March 2021, 13 months later, your QLD shares are now worth $165,000. Your remaining VOOG position has recovered to $44,000. Now, ideally, you'd inject fresh capital into QLD at each of these levels. But if you don't have extra cash sitting around, this is exactly why we keep our base in VOOG instead of cash. It becomes the reserve we pull from when the opportunity hits. Not by predicting the bottom, not by getting lucky, by having a plan before the panic started and executing it while everyone else was frozen. Now, here's what I want you to notice. This isn't a one crash strategy. Look at 2022, a completely different kind of crash. Slower, grinding, painful for most of the year. But the same system applied the same way. Scale in on the way down, hold through the recovery, rotate out on the way back up. By 2024, the result was the same story. Different crash, different speed, different recovery, same outcome. It's not the math that breaks the strategy. It's your emotions. When you're down 40% and every headline says sell, that's exactly when the system needs you to add. That's the whole game. The scaled approach exists for this reason. You never make one big terrifying decision. You just follow the rules. Down 10, add. Down 20, add more. Down 30, go harder. One honest risk: volatility decay. In long, choppy sideways markets, 2 times leverage slowly erodes returns. But this strategy isn't about holding QLD forever. It's about deploying it during crashes and rotating out on recovery. That's the difference between intelligent leverage and just gambling. Buffett said it best: be greedy when others are fearful. This is what that actually looks like with real numbers behind it. Betting on the NASDAQ isn't a bet on one CEO or one earnings call. It's a bet on human innovation. And that bet has paid out every single time. You don't need to predict anything. You just need a plan before the fear arrives. Because when it does, the investors without one hand their gains directly to the investors who do. If you'd rather just hold the S&P 500, there's nothing wrong with that. But if you want to grow your net worth faster, now you know how. If this video changed how you think about your trades even slightly, hit subscribe. Appreciate you watching, and I'll see you in the next one.